Welcome to the Riskwiser Zone, the show where we dive into the world of stocks and finance to help you make informed decisions about your investments. We've got a fascinating story to kick off our show, as reports are emerging that OpenAI, the company behind the popular chatbot ChatGPT, is preparing for a potential initial public offering (IPO) that could value the company at a staggering $1 trillion. This news comes on the heels of a major restructuring effort by OpenAI, which has reduced its reliance on Microsoft and paved the way for more efficient capital raising and larger acquisitions. According to sources familiar with the matter, OpenAI is considering filing with securities regulators as early as the second half of 2026, with some predictions suggesting that the IPO could happen even sooner. The company's annualized revenue run rate is expected to reach around $20 billion by the end of the year, although losses are also mounting. OpenAI's CEO, Sam Altman, has addressed the possibility of going public, stating that it's the most likely path for the company given its capital needs. An IPO would provide OpenAI with the funds necessary to finance its ambitious plans to pour trillions of dollars into AI infrastructure. This potential IPO is significant not only for OpenAI, but also for its investors, including SoftBank, Thrive Capital, and Abu Dhabi's MGX, as well as Microsoft, which owns around 27% of the company after investing $13 billion. A successful offering would mark a major win for these investors and could have a ripple effect on the broader tech industry. As we consider the implications of this potential IPO, it's essential to remember that the AI landscape is rapidly evolving, with companies like NVIDIA reaching unprecedented valuations and AI cloud companies like CoreWeave going public at significant valuations. The question on everyone's mind is, what does this mean for the future of AI and its impact on the global economy? We'll be exploring these questions and more in upcoming segments, but for now, let's take a break. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of finance and economics, where the chips are down for Chipotle Mexican Grill. The popular fast casual chain has just released its Q3 earnings report, and it's a mixed bag. On one hand, revenue came in at $3 billion, slightly below Wall Street expectations. On the other hand, net income was $382.1 million, which is still a respectable number. But what's really got investors and analysts talking is the company's revised outlook for the rest of the year. Chipotle's CEO, Scott Boatwright, cited persistent macroeconomic pressures as a major factor in the chain's decision to lower its sales forecast. It seems that low to middle-income customers are cutting back on dining out, and Chipotle is feeling the pinch. Now, this isn't just a Chipotle problem, it's an industry-wide issue. Other fast food chains like McDonald's and Wendy's have also reported declining breakfast sales, which suggests that consumers are indeed becoming more cautious with their spending. And when you consider that about 40% of Chipotle's sales come from households earning $100,000 or less, it's no wonder the company is feeling the effects of economic uncertainty. But here's the thing, Chipotle is still a strong brand with a loyal customer base. The company has been investing in digital transformation and menu innovation, which could help drive growth in the long term. So, while the current earnings report might be disappointing, it's not necessarily a reason to write off Chipotle just yet. As we continue to navigate this complex economic landscape, one thing is clear: companies like Chipotle will need to adapt and evolve to stay ahead of the curve. Whether that means offering more affordable menu options or finding new ways to engage with customers, the key to success will be innovation and resilience. Welcome back to the Riskwiser Zone. As we wrap up today's show, I'd like to take a closer look at two major players in the tech industry that have been making headlines recently: Celestica and Alphabet. First off, let's talk about Celestica. The company saw its stock surge 10% after beating Wall Street estimates for its third-quarter earnings and 2026 guidance. With a strong outlook for the coming year, it's clear that investors are bullish on the company's prospects. But what's driving this growth? According to the numbers, it's largely due to the increasing demand for AI data center infrastructure from their largest customers. Now, I know some of you might be thinking about adding Celestica to your portfolio, and while it's certainly worth considering, it's essential to remember that past performance is not a guarantee of future success. As with any investment, there are risks involved, and it's crucial to do your due diligence before making any decisions. On the other hand, we have Alphabet, which also reported impressive third-quarter revenue, beating Wall Street estimates thanks to strong growth in its cloud computing unit and advertising business. The company's cloud services division, Google Cloud, continues to be a major driver of growth, with revenue topping estimates at $15.16 billion. However, it's worth noting that the competition in the AI and cloud market is intensifying, with rivals like Microsoft and Amazon Web Services aggressively cutting prices and introducing new generative AI capabilities. As investors, it's essential to stay informed about these developments and consider how they might impact your portfolio. While Alphabet's results are certainly impressive, it's crucial to remember that the company faces significant challenges in the coming months, including increased competition from rivals like OpenAI, which recently unveiled an AI-powered browser aimed directly at Google's core search engine and browser stack. In conclusion, both Celestica and Alphabet have demonstrated strong growth potential, but it's essential to approach these investments with caution. As always, I recommend taking a balanced view of the market, considering multiple perspectives, and doing your own research before making any investment decisions. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.